As Christians, I always like to start this when I give talks to churches. As Christians, we walk a really fine line with money. Because on one hand, we have Matthew 25:14, which is the talents, and you don't want to bury your talents in the dirt. You want to get them out there. When God gives you talents, your gift to Him is using them and growing what you have. But at the same time, we have Mark 10:25, and that's where it's easier for a camel to go through the eye of the needle, that whole one, as well as 1 Timothy, the love of money is the root of all evil. So I think money to me is not an ends, it's the means. So does anybody listen to like sports radio? So like Colin Cowherd, he's a sports radio guy. His big thing is money doesn't change people, it just amplifies who they are. So if you're a good giving person and you get a bunch of money, you can do more good, more giving. That same token, if you're bad with money, like the people that win the lottery, people that are bad with money, they play the lottery, they win, they're multi-millionaires. And guess what? They're broke in about 5 years on average. Why? Because money didn't solve their problem. They're still the same person they were. Instead of losing a little bit of money, they lost a big pile of money. So I think that's something to keep in mind. You want to make sure you want to have your goals and just use the money to make sure your goals are accomplished. What I do, each situation is different, so there's not a one solution that works for everybody. There's just too many variables in it. So that's just the starting point. So rules in estate planning can be changed or broken. Every new Congress that comes along, all of a sudden we're playing a new game. So that's something to keep in mind. And there's just weird situations. I had one couple I worked with where someone passed away. They had like no family, so the two friends, the friends were clients of mine. And so everything was different because it wasn't to a spouse or a direct relative, or it was to friends, and that changes everything a little bit. So every situation is unique. I'm just going to start running through these here. Another thing I always like to mention is don't give to charity if your sole intention is to save money on taxes. Some people will give all their money away all just to avoid paying taxes. Well, that's not necessarily what you want to do either. So if giving to charity is a good idea for you and you want to do it, we can do it in a way that maximizes the taxable benefit. The taxable benefits, so you pay less taxes and can give more to charities. So just again, it's back to the overall picture, not the money itself. Okay. So I'm going to try to simplify this complex issue as much as possible. Here's the one takeaway on the taxation part of legacy planning. Basically, everything you get a step up in basis at death for all the heirs. So if you have a stock that you bought at $10 and it's now worth $100, when you pass, the heirs, or who you give that to, basically get it at $100. So that's a good deal for them. So now if it goes to 101, they would only owe taxes on that $1 gain and not the 10 that you paid on it. That's in general. Okay, so a couple of sidebars to that rule. Life insurance. If you have life insurance and you pass, that all goes to whoever you have as the beneficiary, tax-free. And again, asterisk, you can do it where it would end up being taxed, but in general, tax-free. Okay, the 401k. So if you have your 401k at work, IRAs, things like that. You've been avoiding taxes this whole time as it's been growing, as you've been making contributions. So at age 70 and a half, and it changes now. They've raised it to 72 if you're born at 50, 73. But anyway, when you hit a certain age and the government's like, okay, we want our money now. So once you start taking your required minimum distribution, your RMDs, that's all taxable, 100% taxable. The taxes go right to Uncle Sam. So if you pass and you have a 401k or an IRA, the person who inherits it, they also have to make those payments as taxable gains. So they don't have the penalty, so they might not be 59 and a half yet. But the government's like, nope, you started it, it's an inherited IRA. You have 10 years to get all that money gone because they want all their taxes off that money. You can take it sooner. So if it's a 401k, it's $500,000, the person gets it. I'll just take all $500,000 right now, pay the full taxes on it, so maybe $125,000 off the taxes, and then you can just be done. But you have to do it within 10 years. So 401ks is actually the money we want to try to spend first, in general, out of your accounts, because then the rest of it gets that favorable tax treatment. So a lot of people are like, why would I take the taxable money? Long term, that's the way it usually makes sense. Then there's also annuities. Annuities are a little bit weird because you have what you put into them, and then they have the gain. You you are taxed on the gain as the percentage of what comes out. So that's just a percentage of how much was gained and how much was basis as you get the contributions from that. So those are kind of the three big ones that are different. Otherwise, your home, buy your home for $100,000, it's now worth $200,000. You pass, heirs get that for $200,000, they owe nothing on taxes. They get to step up in basis. Any questions on any of that stuff? The other thing that stinks about RMDs is as you get older, those RMDs grow as a percentage of what you need to take out. So I think it starts at about 3.65%, comes out, the next year it grows to like 3.95 or whatever the number is, and then 4. And then when you get about to 90, it's like 92, it's like 10%. You have to pull out and get taxed on it at least. So those are RMDs. So the more we can get money out of those accounts, the better, because they just start taking more and more of it. The other big thing that, if I could tell everybody, the thing you need to remember is make sure you have the correct beneficiaries on your stuff. So many times they'll set that up when they first do their 401k, and then the 40 years have been working, and it's a different person than it was 40 years ago. So make sure you're keeping an eye on your beneficiaries and updating those. In your wills, the thing to notice about per stirpes is that's when it's the branch. Okay, so you've got 3 kids. If you give money a third to each of them per stirpes, if one of them passes, then it gets split between the kids after them. So it just continues down that branch. That's usually what people want to do, but there are just so many weird situations out there where I know a lady who passed away. She had 10 kids, so she did her job. But she had one pass away who was married, so there was still kids after that. But because of the way it was set up, the husband didn't get anything, but the kids all got the inheritance because she had passed, and that's how it was designed. And I don't know if she realized that, because I mean, it was at that time where they'd been established, he wasn't going anywhere, but that's the way the will was written. So you have to take those things into account when you have big changes like that. The other choice is per capita, and that's just per person. So if you have 3 kids, one of them passes, they just don't get anything, and they get split in half instead of into thirds. So be knowing of what you want. It's hard to kind of plan for all the contingencies, so you have to have that in mind as you're making your plans. And I feel like I'm just flying through this, throwing out things. So if you have questions, ask, or if you want me to slow down.
On that children or nieces, nephews, which is my situation, then we can designate it to that person if they're deceased, split it to the others, or to that deceased's heirs.
Correct.
Is that what you just said?
Yeah.
Okay.
Yeah, so it's either per capita, per person, you can just pick out your people,
okay,
or per stirpes, which is the way best thing is per branch.
What's that word?
Stirpes.
Stirpes.
Yeah, it's like a Latin word or whatever, and that's just what we've always used.
Okay.
So. But yeah, those are usually your choices when you fill out like on your 401k, beneficiary per stirpe, so then it would just go to the next person down the line.
Okay.
So the inherited IRA, the 10 years, we talked about that. It's taxed as ordinary income. I still think it's funny. I'll have people that, they think of their 401k or their IRA as that's my tax-free bucket, and then they go to retire and they'll take out, $40,000, and they'll be like, why did I get this huge tax bill? Like, well, now Uncle Sam is getting his taxes. You're not gonna get away with not paying taxes the whole time. So you can either pay them at the beginning or at the end. But that's something that I like to do. I like playing chess. Like, what's the most efficient way? Do we want to pay it in taxes now? Do we want to pay it later? How do we do that in a smart way? Okay, so here's the fun stuff. Estate and inheritance taxes. So right now, at the federal level, there's an estate tax, and it's almost $13 million, and that's per person. So if you're married, you're basically at $26 million before you'd owe any estate tax. That sounds great, right? Except for that's going to sunset in 2026. So in about 3 years, that's not going to be the case anymore. It's going to reset back down to, and who knows, because Congress is going to change it, but maybe $3 million per person. So, if you've got a home and a good-sized retirement account, maybe you ran a small business, you can get to that pretty quick. And estate taxes are 40% above that number. So if you've got 10 million, and let's just say it's 6, that's $4 million of estate over the limit. Guess what? 40% of that is going to your business partner, Uncle Sam. So that's the kind of stuff we got to plan for. coming up. Okay. And in Nebraska, we have the joy of being one in 6 states that actually has an inheritance tax. That is 1%, and this one is the one that's based on how close of a relative it is. So if it's direct children, it's a certain amount you can give. If it's a distant relative, it's a different amount. And if it's someone outside of that, it's an even higher amount. But basically, it's a 1% tax on assets to whoever inherits it. So, the estate tax from the federal government is taxed to the estate. Okay, so that comes out before it gets to the person. The inheritance tax is when I get money from someone that passes, the state charges me 1% on whatever it is. So that's who pays those taxes. That's the difference between the estate tax and the inheritance tax. Okay, so also there's portability. This is getting a little bit into the legal mumbo jumbo, so this is maybe more of a question for your attorney. But I always bring it up because, like, let's say right now it's that $13 million exemption. It's a little bit less. So if you pass, everything goes to your spouse, tax-free, penalty-free. That's just the joy of being married. It can just all move over. But as long as you claim portability on that $13 million, let's say you give some of it to the kids and you have $6 million left over, that portability can now be your wife or husband can have the 13 that they have plus your 6 that you didn't use. So that gives them 19 million of protection. So, God forbid, if something were to happen before 2026, you can claim that portability on that 13 million, and then your spouse can still use that to distribute assets in the future. So that's a very important box to check when you talk with your attorney to keep that exemption just in case they do decide to leave it. Who pays the tax? We covered that. Killing it time. So any questions on that so far?
What is portable? Where does
The
it come
exemption
from?
amount. So like if it's $13 million and you only distributed $3 million, so that $10 million just went to your spouse and whatever, but you gave out the 3. The other 10, your spouse now gets to use on top of her other exemption. So let's just say something, God forbid, were to happen today, 3 million went other places, 10 million of exemption, so then your spouse gets 10 million of exemption, and the spouse doesn't die until after 2026, and now the exemption's back down to 3. But plus your 10, she can still do 13 million and still give it away estate tax free. So that way you can, both partners can use that.
So the portability is permanent.
Yes, yep, that'll stick with you. Yep, so that's a big deal if they don't change it.
The estate tax that's federal has these exemptions, changes in 2026.
Yep.
Does the state inheritance tax have any level of exemption?
Again, it's starting to be an attorney territory.
Okay.
But I don't, they can always change it at any time
Oh, yeah.
because it's the government. But it's not set to sunset right now. Like that's how we anticipate. This is set to be done in 2025.
Right, yeah, I understand that.
Yeah. So yeah, that's gonna for sure end. This is what the plan is as of now. Okay, so gifts. This is what my parents were big on because my mom's philosophy was she wants to see her money being enjoyed and see it used. She's like happy to pay for meals. She's like, oh, it's just coming out of your inheritance anyway. And so she prefers it that way. But gifts are great because you get to see your money being used. You get to observe the management with kids. Some people want to see how their kids can kind of handle a little bit of money to see if they want to give them more. All kinds of situations out there. And it's just a good tax-free way of doing it. So here are your options for giving gifts. So for charities, 501c3s, no limit. As much as you want, to whoever you want that is in that category. So that's unlimited. Medical, so you can give to hospitals, someone's medical expenses, as long as that money goes directly to the hospital, unlimited. Education, so higher education, private schools, unlimited. Yeah, I believe you have to give that one directly to the schools as well. Pay for your grandkids' private schooling at wherever, unlimited. Okay, this year, and again, these numbers change every year. So the exclusion this year is 17,000 per person. So a married couple can again do the 34, and that's per person, unlimited number of people. So you can give your kids each 17,000 from you, 17,000 from your spouse. You can give your friend next door up to 17,000. You can give me 17,000, all completely tax-free. You can give more, but if you give more, then as the gift giver, you would owe the taxes on the gift at that point. So you can give as much as you want, but then after 17,000, that's all taxable to the person giving the gift. The person receiving the gift, no taxes. So a lot of people, to get money out of their estate, will give the kids 17,000, and if each spouse can do it, they'll both do 17,000, and help kind of lower that estate. That's a good way of doing that tax-free. What other considerations did I want to make sure to mention? Yeah, so your main goals as an individual investor, I gotta talk about this, is to avoid taxes and to beat inflation. So like what used to be a good idea in being money in bonds, as interest rates have been going up, bonds have been doing this. So bonds are not the safe play today. But because of interest rates going up, CD interest has gone up. So CDs are starting to take over as your safe play. So you can build out a CD ladder. People used to do bond ladders. So a ladder is just where, let's say you've got $300,000, $100,000 you invest for 1 month, 100 you invest for 2 months, and 100 you invest for 3 months. Okay, so when that 1 month is up, you take that one and invest it again for 3 months. So every month you have a big CD coming due, you can take the interest, or if you don't need it, you put it back in, and you just keep rolling it over. That's a good way to have safe money that's still coming available. And if it's just in a regular account, it's gonna be the step up in basis for the kids anyway, so very little taxes on that, if any. Okay, covered gifts. The giver of the gift, the donor, is the one who pays the taxes. Other considerations, so there's long-term care insurance. The stats are 70% of 65-year-olds to age 80, or to 65-year-olds are gonna need some type of long-term care insurance. They've designed long-term care insurance to protect your assets. So let's say you have a rental house that's worth $100,000. If you have long-term care insurance that's $100,000, that will protect that rental house. So if you have to go to a nursing home or assisted living and you have to spend down, if you have a policy that's $100,000 in your house out, they can't force you, if you've maybe heard of the sell down, they can't force you to sell that rental home anymore. So if you have assets at whatever it is, you generally, you're gonna want a policy that covers all those assets. That keeps them protected. If you've heard the horror stories of someone going into the home and then they do a great job, they've done a great job of saving their whole life, they've been really diligent, being smart with their money, and then something like that happens in the fourth quarter and just blows it all up, and they end up giving all those assets to the nursing home instead of to the people they want to give it to. That's the last risk you face.
You mentioned spend it down. Can you tell me the circumstances when you have to spend it down?
Yeah, so the problem is it's just a real tricky situation. So usually people have their home, their 401k, and then, oh, we have to go to the nursing home. So what happens is the nursing home's like, well, you can pay to go here, and they just keep paying to go here, and then pretty soon they've lost everything to afford to go to that home. Well, they cannot force you to sell your home. You get like your car, and you get like $3,000 of assets, or whatever the formula is. They can't technically force you to sell that, but if you don't, they're not gonna let you live there. So then you can end up on Medicaid, and that will protect your assets, but now they're deciding where you get to go, who's gonna share a room with you, who's control at that point. So it's just one of those tough situations where it can be protected against if you get the coverage. If your estate's over, what's a fair number? Over about probably 6 million, you can probably just self-fund that. But the problem is nursing home care. I was running quotes for a guy, and we were assuming about $7,000 a month, and he laughed at me. He's like, had to put his mom in a nursing home, and he's like, that's ridiculous. Like, it's way more than that, because she needed the full care. She needed the medication, she needed help moving, she needed everything. So it really just depends on the level of care you get, the place you're at, and all that sort of stuff. And some people think Medicare will cover it, and I don't remember the exact numbers. And they do cover a little bit, but not really what you're gonna need. So.
I've always thought that the spend down asset was the spend down question was what is required, not required, but you do that in order to be eligible for Medicaid.
Correct.
But you're talking about something a little bit different, from what the way
No,
you read it.
no.
And that is that the insurance policy or insurance requires a spend down, or the long-term care facility requires it.
No, so you're right, so it is for the Medicaid.
Okay.
The problem is, like, the people I've talked to that are in this situation, they're like, yeah, I know I don't have to sell my house, but I need to sell my house because I want to go here and not have to be on Medicaid and not, because then you lose all control of whatever. Once you're on Medicaid, they tell you where to go, they tell you if you're taking a roommate. So yeah, you're right, for Medicaid.
So, help me understand.
Yeah, so sorry, go ahead.
How frequent do you find people spending down in order to get on Medicaid? Because there's, of course, there's a stigma attached to it, to
Right.
a certain extent. There's, pressure from neighbors and other landowners who say, hey, I'm picking up the difference here for you spending down. Those are all arguments against spending down, against Medicaid. So I'm trying to understand, is that the only time we're talking about spending down is to be able to qualify for Medicaid?
Yes.
Okay.
Yes, that's correct. Okay, so like if you're a million, and again, these are ballpark numbers, so everything's individual, everything's different. $1 million and less, you probably don't need a long-term care policy. You're just gonna plan on using Medicaid to cover any nursing home expenses because there's not a whole lot there to work with. The like 1 million to 7 million, that's the spot where you have some built up, you have some wealth there. And if a nursing home ends up being the thing and you have, God forbid, Alzheimer's and you're there for 7 years and they'll just drain all of that, that middle section is the one that really gets hurt by it. So if in that middle section, if you have a long-term care policy, that will protect when they force you to do the sell down to get on Medicaid, you get to protect your assets, your rental home, maybe your business that you still have. That's where that helps.
Just looking to our congregation, which is a senior congregation, as a lot of congregations are. And I think the spending down to get on Medicaid is a concern to them. They don't know exactly why. They know you gotta do it in order to get on Medicaid. They know that they don't wanna do it because they don't like to go on Medicaid, but they want the benefits of Medicaid. So I just think it's worth knowing a little bit more about, not from you necessarily, but I think in terms of ourselves and the rest of our folks in our congregation. I'm on the legacy committee or whatever. I'm trying to explain it. I've got to understand it a little better because I think it's kind of an unspoken but almost a dominant issue with a lot of Ulsters.
Yeah.
Because they know I don't want to sell the 80 acres that my
The
dad
farmland.
had, and my grandfather had it.
Yep.
But they don't realize they're gonna have to sell it, or they have to do something with it in order to be able to have money for a lasting legacy.
Yes, or if they can get a long-term care insurance policy for if they have $700,000 worth of land, $700,000 worth of long-term care policy, they'd be protected in that sell down. So they could keep that land now, even though they had to do the sell down, because they have that policy paying. And now they need to go on Medicaid, everything's been exhausted. They don't have to sell that farmland now, and they can still qualify for Medicaid.
And they don't have to sell it because why again?
Because they had an insurance policy that was that amount of money.
Okay, so it's an insurance question.
Yeah.
You have to have it in mind, insurance. Okay.
I mean, okay, go ahead.
Go ahead.
Well, maybe I'm dominating that part of it.
So if they use up the $700,000 of insurance.
Yep,
Then the land becomes
nope, still safe.
still safe.
Okay.
Yep,
Thank you.
yeah, that's why that's so important. That's why when you're under the million, you really don't need long-term care insurance because you're not really protecting anything unless you just want to be able to maintain control of what happens. That 1 to, I'd say 7, maybe 10, in that mid-range where you've built up some assets and you want to protect those and give those to the next generation or whoever, you buy a policy that's big enough to at least cover those assets. That'll protect protect them. So even if you have to end up selling down, they can't force you to sell anything else to be
So-
on Medicaid.
What is the insurance that you're buying? Is it something that?
It's long-term care insurance.
Yeah, I understand that, but how does that affect the 80 acres? Is it saying that that can be held in and given the way you would give anything else, but
Yep.
it would not be, something?
Yeah. Yeah. Yeah, so it's just, if you have a long-term care policy, whatever the dollar amount is worth, is the dollar amount on top of the normal, like your home, your car, your wedding ring. And then however big your policy was, now you can protect this much to your sell down. So whatever that is, if that's farmland, if that's your 401k,
What if the value of the farmland increases in value?
yep, then you potentially would have to sell off a piece of the farm. Because then, yeah, I mean, you have to plan ahead on it. That's exactly right, though. What happens when your 401k goes up in value? You're like, well, I protected, a bunch of it, but that's always the issue. You gotta kind of be planning for that. Any other question on that? Yeah.
When you talk about the value of the long-term care insurance, you're using 700,000, you first used 100,000. Is that total payout? Because that 100,000 is gonna be gone in less than a year.
Oh yeah, yeah.
So the figure you're saying is total payout
Yes, their total budget.
until that money's gone by the insurance.
Yeah.
Okay.
Yeah, so, there's two ways we do long-term care insurance. There's the one way where the people are just looking for the insurance, they just wanna have control of where they go, where they stay. Like, we wanna make sure a policy pays $7,000 a month forever, or for 7 years. I don't think there are any lifetime benefits anymore. But you wanna make sure that you're covered and you have control of where you stay at that point. Or, the other group of people have assets that they wanna make sure their assets are protected, they can pass it on. So we pick a policy that at least covers those assets. So maybe it doesn't even make your full payment each month, maybe it's just a $2,000 a month policy for 7 years. But it's enough to cover all your assets because of its total bucket value. Yeah, great question. So those are basically the two ways we determine how much coverage. It's like life insurance, we can decide how much coverage we want. Or just enough to hedge. Yeah, because really that's the last major thing that could really screw things up financially. If anybody's had to go through that and stuff on. Okay, 2AJ, typical basic. Okay, another option is Roth conversions. So people have their 401k, IRA. You technically can't do a 401k. So IRAs, you have your IRA, you're tired, and you realize you have to take minimum RMDs and all this stuff. You're like, wait a minute, I can just move that whole thing over to a Roth right now, pay taxes today on what it's worth today, and then hopefully it'll go up in value. And now it's in a Roth, and it'll go up tax-free, and I can take it out tax-free and give it to the next generation tax-free. So we can do Roth conversions. Right now that's a loophole they're allowing at the government level because they're like, yeah, we get that big bucket of money today, yeah, we'll let you do that. But usually when the rubber hits the road and they've got this 100,000 that they now need to pay taxes on, and so they're gonna send 30,000 of it to the government, they're like, well, it's 30,000 check to the government isn't such a good idea. It's a little bit harder to do. Personal finance, that's a little bit more personal than it is finance. So, but Roth conversions are available to you if you want to save there. Qualified charitable distribution, so maybe you have to take RMDs and you can just go give it right to the church, give it right to a 501c3.
Or the Nebraska United Methodist Foundation. You're
Yeah, or
supposed
the
to say that.
foundation, yeah. The other ones are probably, yeah, so, but that's an option, so it can go just directly, comes out, goes right to a charity. Let's see, it must be an IRA up to 100K. It can't be from an employer plan, so if it is a 401K or a 403B, you actually can't do that with those. It has to go direct to the charity. Make sure you get a receipt. That's another one you want to double check with your accountant. Make sure that's correct. But it can't count as your RMD, as we talked about. The other thing I get asked a lot is, they're like, what's your hot stock tip? I am not a hot stock tip kind of guy. I think you just need to be diverse. I remember when I first started investing, I bought into BP. So BP, strong company, they do the oil stuff. And I bought into that, if you guys remember, it's a while ago now, but they had that big oil spill in the Gulf, just leaking oil. I owned BP when that happened. And so even though it's a good company, they paid a dividend, they had a good price to earnings, like it was a strong company, their price just tanked because of something they couldn't control. So ultimately with stocks, you don't know if the pharmaceutical company is gonna invent the cure for AIDS, or if they're gonna have something that just causes everybody to go bald or something. So you just don't know. Anybody who says they do, they're just lying. So I'm not the hot stock tip guy. Be diversified, have a bunch of different, lots of things. Some will be up, some will be down, but overall, it's a yo-yo going up the
Are
escalator.
you going to finish your personal story? Did you keep BP till
I
it came
did.
back?
I did hang on to
Or
it.
did you sell it at a loss?
Nope, never sell at a loss.
Okay.
Yeah, but I ended up keeping that one, and it's since recovered, but, so that's good, but, yeah. What else? All right. Any other questions so far? We talked about the lottery. The other thing that my mom mentioned to me, my mom's a smart lady. They always see in the movies or like on commercials, and you see they're all gathered around after the funeral, and they're talking to the attorney, and they're like, and you get the car, and you get the swampland, and you get the, you know, like it's a big surprise to everybody, right? Don't do your will like that. Again, personal finance is more personal than it is finance. Talk to the kids, talk to whoever you're going to give things to, so they know what's going on. Maybe they've always liked that picture on the wall. Maybe they've always liked this little thing on the Christmas tree. And so get it ahead of time. Be open book. There's two things that are for sure in life: death and taxes. I can help you with the taxes. You're in the right place for the guy to help you with death. Let people know that I know a lady who passed away. It was a lady with the 10 kids. One of the kids passed away. Great family. Everyone got along great. Everything was a good, loving family, just how you would want it to be if you could just design it, right? Like just, they got along great. Guess what? The grandma dies, and her kids, it started to be a little bit of this. There were 2 executors of the estate, and money was going here and not there, and why is it taking so long? And you sold the house for this much, and it kind of just started causing ripples of this like really otherwise perfectly loving family. So I think a lot of that can be taken care of ahead of time. Being open, hey, I want to give you, I know you've always liked that car. I know you're the farmer, we want to give you the farmland, but we're going to give cash to the other kids. Be upfront, honest, talk about it out in the open so people can say what they want. And so when it does eventually happen, everybody knows what's going to happen, everybody knows the plan. It's hard enough already, but at least there's clarity in the situation. Oh, and I'm probably out of time. Any questions or anything on that?
Yes, you covered Roths and all that.
Yeah.
Any recommendation for highly appreciated farmland? Any tricks?
Keep it in the estate and just take the step up in value. Don't try to sell it ahead of time. Don't try to sell it to the kids for $1. Keep it in the estate. Your best option if you want to try to level that out is if you want to do life insurance, so it's a big pot of money for someone else if someone else wants the land. Yeah. It's almost like a buy and hold situation. Like what are you, and maybe we talk offline another time, but are you specifically thinking of anything, or just the land that's way more than you paid?
Put it in trust for grandchildren?
Yeah. Well, yeah, people have been moving to the trust, and trusts are nice because it keeps it out of probate. It's really smooth because you just follow the order of the trust. You have to be a little bit careful there because if the trust makes a very small amount of money, it immediately starts getting taxed at the highest rates. So it is in a trust right now.
Not yet.
Talk to the attorney and the accountant before don't just put it in a trust automatically. That's not necessarily going to save the day as far as avoiding any taxes on it. The step up in basis on its own is probably the best way to go as far as the taxation. Then you don't pay the taxes on it, and they don't pay the taxes on it.
Don't want to get them get the money and then spend it, so.
Yes. So in that case, you may want to do the trust.
Transfer to trust and interest in the trust.
Yep. And then you could have the trust divvy out just a portion of it so they don't go overboard. Yeah. Yeah. There's some considerations there we'd have to go through, but I think that's it for me.
Any pitfalls in what I mentioned?
I don't know enough about that
Okay.
situation.
Sorry to put pressure
But
on you.
yeah, if you're looking to limit how much each person gets, going to the trust might be the way to do it. So you don't just get a big chunk all of a sudden, and then, especially if you have one that's bad with money and one that's good with money. There's some things that go along with that. So, but thank you for your time. I've got my cards up here if you want to talk more.
Thank you.
Thanks, Christine.
Ashley will be speaking next, and Marshall, you can talk to her now.